Deferred tax is simply a technique in which the entity tries to anticipate its future tax liability and provides for that liability in the financial statements. The process by which the entity does this is based around the conceptual framework definition of assets and liabilities. We know that the definition of assets is access to future economic benefit, and therefore the unavoidable consequence of holding an asset in the business is that it will generate taxable cash flows at least equal to its carrying amount, and when it does, we will have to pay tax. So if, for example, an asset had a carrying amount of 100, it would generate at least 100, and at a tax rate of say 30%, we would have to pay tax of 30. Given that this is an unavoidable consequence, we make a provision for this now. We also know that the definition of a liability is the obligation to transfer economic benefit. The unavoidable consequence of having a liability in the business is an economic outflow equal to its carrying amount, and when this happens, we will receive tax relief, and therefore we set up a deferred tax asset for this now. So if we had a liability of 20, this would, at a rate of say 30%, create a deferred tax asset of 6. If we look at the net impact of the assets and liabilities held in the business, we see an overall deferred tax liability of 24. Having set up the basics, let's now explore these concepts in more detail. You will often hear the phrase, the accounting carrying value less the tax base equals the temporary difference. As an example, for property, plant and equipment, the accounting carrying value is the net book value, and the tax base is the amount of future capital allowances available on the asset, or, as it's otherwise known, the tax written down value. If the asset had a net book value of 100 and a tax base of 30, the temporary difference would be 70. The asset would generate 100 of cash, the taxman would let us off the first 30, and we would have to pay tax on the remaining amount of 70. It stands to reason that if we revalued an asset from 100 up to 120, we are now saying that the asset would be capable of generating 120 of cash, and therefore we would have to increase the deferred tax provision by the amount of the revaluation. There would be no corresponding increase in the tax base. Given that the thing causing the increased deferred tax, e.g. the revaluation gain, is recorded in equity, it would make sense to match the charge for increasing the deferred tax against it. Therefore, the journal for the increased deferred tax on a revaluation is to credit deferred tax liability and debit revaluation reserve. If the item causing the deferred tax is recorded in equity, then so is the deferred tax charge relating to it. Another way of thinking about the tax base is to consider it as the amount being considered now by the taxman for tax purposes. Take, for example, sales on credit, which are taxed on the cash basis. As an accountant, we would record a receivable under the accruals concept, but the tax base would remain at 0 as the taxman is not interested in the item until the actual cash is received. So a credit sale of 100 would result in an accounting carrying value of 100. A tax base of 0, and a temporary difference of 100. In other words, when the customer does pay us the 100 in the future, we will have to pay tax on this, and so we set up the provision now. Once we understand this concept, it becomes fairly straightforward to spot the temporary differences. For example, imagine money being spent on development expenditure. The capitalization of development expenditure means that we are confident that revenues will be generated in the future when the product launches into commercial being. 100 spent on development expenditure would give an intangible asset with an accounting carrying value of 100 and a tax base of 0, since the taxman will tax the revenues on a cash basis in the future when they are received. The temporary difference would therefore be 100. The same concept applies, of course, to liabilities. Imagine establishing a provision for a future liability of 100. Tax relief will not be granted on this now, but in the future when the actual costs are paid. Therefore, the tax base would be 0, as of the accounting carrying value of negative 100, the taxman is not interested in any of it now. This would give a temporary difference of negative 100, technically referred to as a deductible temporary difference, and we can see that it would of course reduce our future tax liability and therefore act as a deferred tax asset. We must of course be careful not to assume that all liabilities result in deferred tax assets. For example, there would not be any tax relief on an environmental provision. In this case, we would have to set the tax base equal to the accounting carrying value so that the temporary difference comes to zero. There is no tax relief on anything bad for the environment, anything illegal, or anything unethical. As well as the aforementioned items, let's also consider some deferred tax consequences associated with the acquisition of entities. As part of our accounting for the acquisition, we know that a fair value exercise must be carried out on the subsidiary's net assets, often resulting in an increase in these net assets. If the value of the net assets are increasing, we are saying that the business is capable of generating more cash, and thus must ultimately pay more tax. We would therefore have to increase the deferred tax liability. This increasing liability would decrease the net assets, and this increases the gap between the amount paid and the amount acquired. In other words, goodwill would get bigger. The journal, therefore, for recording the deferred tax implication of a fair value exercise is to credit deferred tax liability and debit goodwill. Let's take a look at an example of this. Imagine that we acquire 100% of a company for 100. At the date of acquisition, the entity has net assets of 50, made up of share capital of 30 and retained earnings of 20. The entity has property which has a market value that is 10 higher than the book value. Taking this fair value adjustment into consideration, we would see a cost of investment of 100 compared against net assets of 60, giving a goodwill figure of 40. However, we must also take into consideration the increase in the deferred tax liability caused by the increased value of the property. The increased deferred tax liability, assuming a rate of 30%, would be 3. This means that the net assets acquired are actually 57, and compared against the cost of 100, this gives a revised goodwill figure of 43. We can see that goodwill has increased by 3. The journal, therefore, for the increase in deferred tax as a result of the fair value exercise on acquisition is to debit goodwill 3, credit deferred tax liability 3. It is worth mentioning that there is no deferred tax impact of the actual goodwill figure itself. The reason for this is that it is not the goodwill that generates the future net income of the business, but instead the underlying assets and liabilities. It is on the underlying assets and liabilities that we calculate deferred tax. There is also a deferred tax impact of intercompany sales. Essentially, as accountants, we do not recognize the profit on intercompany sales until the goods are sold outside of the group. The taxman, however, will charge tax on these sales now. So in the future, when the goods are sold outside of the group, the accountant recognizes the profit, and so the accounting profit increases, but the taxman's profit remains static, as the taxman has already dealt with the transaction. The extent to which the taxman's profit exceeds the accountant's profit is reduced. In other words, the unrealized profit on intercompany sales acts as a deferred tax asset. From a balance sheet perspective, we simply see that if there is inventory with a value of 10,000, but inclusive of 2,000 of unrealized profit, the accounting carrying value would be 8,000, and the tax base would be 10,000 since the taxman does not deal with the provisions for unrealized profit. This would result in a deductible temporary difference of 2,000, in other words, a deferred tax asset based on 2,000. If the arguments for deferred tax work for one asset and one liability, they also work for all assets and all liabilities. In other words, the net assets of the business. In general terms, if the net assets of the business increase, we increase the deferred tax provision, since the business is capable of generating more cash, and thus we will have to pay more tax. If the net assets of the business decrease, we decrease the deferred tax provision, since the business is capable of generating less cash, and therefore we have to pay less tax. Balance sheet up, deferred tax up. Balance sheet down, deferred tax down. This concept helps us to deal with tricky concepts, such as the deferred tax impact of convertible debt. Imagine that a company is applying split accounting to compound instruments for the first time. Rather than have a liability of, say, 2 million recorded in its financial statements, it would split the instrument into its debt and equity components, resulting in, say, a liability of 1,848,122 and an equity element of 151,878. The recorded liability has decreased, and therefore the net assets have increased, and thus we must increase the deferred tax provision by the size of the equity component of the compound instrument. We increase the temporary difference by 151,878. So deferred tax is about the unavoidable tax consequence of holding assets and liabilities in the business. In this case then, there is no need to explore the equity section of the balance sheet, as this is just a reflection of the assets and liabilities. Also, there is no deferred tax on cash, and of course, on the deferred tax provision itself. Let's now take a look at an example that draws all of this together. A typical balance sheet of a company might include the following. We see property, plant and equipment of 14,000 and the capital allowances available on these items total 10,000. Therefore the tax base is 10,000 and the temporary difference is 4,000. We're also told that included in the value of 14,000 is a revaluation of 500 that has occurred during the year. We must therefore make sure that when we put our journal together, the increase in deferred tax caused by this revaluation, e.g. 500 times 30%, which is equal to 150, is taken to the revaluation reserve. The next item is a trade receivable with an accounting carrying value of 4,500 compared against a tax base of 5,000. It would appear here that the accountant has set up a provision for doubtful debt of 500. This is done now by the accountant, but tax relief is not available on this until the debt actually goes bad, resulting therefore in a tax base of 5,000. This gives a deductible temporary difference of 500. In other words, a deferred tax asset based on 500, since when the debt goes bad in the future, we will receive tax relief. There is then the cash balance of 5,000. There is no deferred tax implication of cash, since cash does not generate cash. Therefore, the tax base is simply equal to the accounting carrying value, resulting in a zero temporary difference and no deferred tax. On now to the convertible debt with a liability recorded in the financial statements of 9,600 and a tax base of 10,000. Here, split accounting has been applied to the compound instrument of 10,000, resulting in a liability component of 9,600 and an equity component of 400. The accounting carrying value of negative 9,600 less the tax base of negative 10,000 results in a chargeable temporary difference of 400. In other words, the reduction in the liability has increased the net assets, and thus we must increase the deferred tax provision based upon the increased net assets of 400. Split accounting is not considered by the taxman, and therefore the tax base has remained at negative 10,000. We then have an accrued liability of negative 1,000. The accountant has recognized this now under the accruals concept, but the taxman will not deal with the liability until the cash is paid out. We therefore have an accounting carrying value of negative 1,000 and a tax base of 0. This results in a deductible temporary difference of negative 1,000, which will therefore act as a deferred tax asset since tax relief will be available in the future. You'll then notice a provision for environmental damage. Notice that the tax base has been set equal to the carrying amount in respect of this item. Since there is no tax relief for environmental damage, we need the temporary difference on this item to equal 0. Otherwise, it would look as if we were creating a deferred tax asset. Adding up all of the temporary differences, both chargeable and deductible, gives an overall temporary difference of 2,900. At a rate of 30%, our required deferred tax provision is 870. We can see that the existing deferred tax provision is 500. We have, of course, not calculated any deferred tax on the deferred tax provision. We do, however, need to increase the provision by 370. The credit entry for the journal is therefore credit deferred tax liability 370. Of the increase in the deferred tax provision, don't forget that 150 of it was caused by the revaluation reserve, and therefore we must debit the revaluation reserve with 150. The remaining 220 is a debit to the tax line in the income statement.